Hey, good morning. Happy Monday mortgage market update. Hope it was a good weekend. Lots of crazy things going on. We're going to cover something today that I thought was kind of interesting, that I was perusing about getting paid to move. That's right. Stay tuned. Getting paid to move. We're going to talk about some household debt. We're going to talk about should you lock or not to lock. We're going to talk about the Fed's next move in November or December. And you're going to love it. You're going to be very interested in all of these things I'm about to tell you. But there are several cities out there right now that will pay you to move, not to change your job. Susan Horton is watching. Your husband is awesome. Getting paid to move, not to change your job, but if you're able to work remotely and not in an office. In Tulsa, Oklahoma, there's a company called Tulsa Remote. They're offering $10,000 for workers to relocate and revive the economy in Tulsa. It's not only Tulsa. West Virginia combines cash and financial incentive that will equal, I think they were talking about $20,000 to folks to move. Again, it's cash financial incentives to West Virginia. It's run by a non-for-profit company in West Virginia called WV Ascend, ASCEND. But wait, there's more. West Lafayette, Indiana is giving you $5,000. Savannah, Georgia is giving you $2,000. Topeka, Kansas, where we all want to live, is giving you $11,000 to move. Again, not quitting your job, but to work remotely. So you can go on a website, and that website is called makemymove.com. And you go on there and you click around the website, and it tells you different cities that will actually pay you to move. There's a lady that was in an apartment in New York, moved to Tulsa. They gave her, what did I say, 10 grand? 20 grand. 10 grand. Oh, whatever. They gave her a lot of money to move. Rented an apartment there. Cost of living much cheaper in Tulsa. She kept her job, bought a car, bought a house. Now she's a thriving member of the Tulsa economy. So again, it's makemymove.com. Go on there, and if you're going to relocate, if you can work remotely, you may as well get some cash for it. Household debt. Household debt rose by $85 billion to a total of $14.6 trillion in the first quarter. This is mainly due to mortgage and auto loans. Mortgage rates still low. A lot of people still refinancing. A lot of people buying if you can find a place. And auto loans. Auto loans are increasing. Rates are lower. And the interesting thing they're saying now is used car values. Used car values are higher than they ever have been. I had a client last week. He bought a car last year, used, traded it in last week, still used, and got $1,000 more than he bought it for last year. So if you are in the used car market, if you have a used car and you're looking at trading it in, they are saying now is an opportune time to trade in your used one. Credit card debt fell, which was a surprising number. It fell by $45 billion. A lot of that is due, what they're saying is the stimulus checks. If you're not out buying stuff that you don't need with it, like golf clubs, credit card debt went down by $49 billion in the first quarter. To lock or not to lock? That is the question. People are asking me constantly, should I lock, should I not lock? My advice is I won't give you advice on locking, simply because if you do lock and rates go down, you're not going to be happy. But luckily, here at Prime Lending, we have an option. It's called a float down option. If your lender does have it, ask them about it. If you're applying for a mortgage, whether it's a refinance or a purchase, ask them about the float down option. What the float down option is you lock in, rates are great. If the rate is lower by up to 3/8, 20 days prior to closing, you can float down, doesn't cost you a penny. Give you an example. Say you lock in at 3%. 10 days before closing, rates are 2.75. You can lock in, it doesn't cost you a penny. So it gives you the security of knowing the rate you're locking in at won't go any higher, but the opportunity, it might go lower. This is very exciting stuff, I'm telling you. Home prices up 12% over last year. What that is doing is making higher rates and home prices up are affecting affordability. Michael Sticka, good morning. So affordability, your rates are going up, your home prices are going up. Guess what? You're not going to be able to afford as much. Builders cannot keep up with the demand. I know we talked about this a couple of weeks ago. The price of your lumber Your wood is rising by almost, it was 33 bucks a year ago, $93 for that same piece of wood. Now, so again, if you are building and you want to ask your builder, you may see an escalation clause in there. That escalation clause simply states the builder can increase the price of your build without, they have to tell you, but it's going to be huge. And like we talked about last week, the average home being built is going to increase by $36,000 by the time they attach your doorbell. So be careful if you're building. I also suggest you're also building at the high end of the market. You're going to build a house for $1 million at the high end of the market. When things settle down and more houses get on the market, when more houses are available, the market is going to get back to normal, meaning that $1 million house that you bought might now be worth $800,000. Very similar in the purchase market. If you have to move, know that you're moving in the height of the market. Know that you may pay more than the market value in the height of the market. What does that mean? Does that mean you're walking into negative equity? Who knows? They are saying more houses in the market within the next 12 to 24 months. If you don't have to move, sit tight. If you do have to move, don't do it yourself. Get a realtor. I had a conversation with someone over the weekend that was going to just do it by themselves. There's a lot to risk. You don't know it. Your contracts, your title, taxes, credits. Don't do it yourself. If you don't have a realtor, let me know. I got a few. Help you out. Fed's next move, what they are saying. In November and or December, will they increase rates? If they do increase rates, what will that have an effect on the mortgage rates? Generally, us mortgage folks price any move that the Fed may do into it prior to them doing it. For instance, rates went up when the last time the Fed increased rates. Mortgage rates actually went down. What you want to take a peek at, not always, not 100%, but you want to take a peek at the 10-year Treasury note. I remember a mortgage guy and myself a long, long time ago, we're having a hot dog, watching the news. That's how exciting we are. The 10-year note was like 0.6%. It was insane. That was the first huge refi boom. Right now, I didn't look at it this morning, but you're probably about 1.6, 1.7. As that increases, your mortgage rates are going to trail from there. So if you're a nerd like myself, you can go ahead and keep an eye on that 10-year Treasury. It doesn't always result in it. I always say when you see gas prices go up, mortgage rates are going to go up. Again, they're not that high. They're in the 3s. Certain rates are in the 2s. What you can do, another question that was brought up to me to bring up today, if you were in a 30-year loan, 4%, and you put 10 years in the house, you do not have to go back to a 30-year loan. You can do a 20-year loan. You can do a 15-year loan. You may be able to refinance that loan, cut a term off your loan, and still lower your payment. It could be a perfect world. Also, what you may want to do, and you may be part of the 25%, but 25% of the population has their this is annoying, has their mortgage rates over 4%. 25% of the population has their mortgage rates over 4%. What that means is out of 4 people you know, one of you is over 4%. You want a rate quote? Call me. Christy Young's not watching. He's calling me. You want a rate quote? Give me a call. Takes 5 minutes. You're buying a house. Get pre-approved. You want to talk about mortgages? Let me know. I'm here all week. Have a good week.